Hello everyone, my name is Harsh Dabade and I am going to talk on commercialization of Microfinance Institute. We will explore how this organization transitioned from social focused entity to commercially viable financial institute. To, to begin with, let's define microfinance at its core. It provides small loan to low-income borrowers, particularly women in the rural areas. The goal is to promote financial inclusion and elevate poverty by bridging the gap left by traditional banks. The case Let's look at the case study of an NGO that transformed into NBFC. Initially funded by donor grants, the organization faced an unpredictable funding despite a sharp increase in loan demand to scale and access stable capital. It converted into a commercial structure that allowed it to borrow from banks and attract equity investors. So, why was this necessary? Primarily because donor funds were inadequate to meet the high demand for credit. This shift introduced professional management and financial stability through it. Also, made the financial target being to carry more weight in the decision making. Let's speak on commercialization. Commercialization marks a crucial shift from rely on donors to prioritizing financial stability and profitability. This transition also brings increased regulatory scrutiny to ensure the practice remain responsible. Private equity investment. Private equity has been a major driver, providing the capital needed for rapid expansion and new branches. However, this often comes with immense pressure to meet aggressive loan targets set by the investors. Case study: Growth pressure. In our second case study, an NBFC used private equity to scale quickly and adopt new technology. But this growth came at a cost. Field tasks, field staff faced aggressive disappointment targets to satisfy investor expansionary for higher returns. The benefits included large-scale capital and improved efficiency. The risk, however, involves over-lending and a reduced focus on whether the loan were actually suitable for the borrowers. A major concern in this sector is mission drift. This happens when institutes start targeting less poor clients with large loans, which can lead to reduced focus on most vulnerable population. Profit versus poverty. In this case, consider an microfinance institute that moved from serving serving poor rural women to urban clients with higher incomes, while profitability improved because these clients were lower risk. The institute drifted away from its original social mission. So the questions, this drift occurs when profitability becomes the primary objective and the poorer clients are seen as high risky, while serving whether clients can cross substantiary services to poor, excluding the poorest entirely unremained the core purpose of microfinance. Interest rate controversy. Interest rates are a point of major controversy because these rates are often higher than traditional banks. It can lead to transparency issues and borrowers' distrust. Case study: One fast-growing microfinance faced public backlash from high interest rate and a lack of transparency in how they calculated those rates. This drew heavy media and regulatory scrutiny. Why are rates higher? It's due to high operating costs, small loan size, and the risk of lending to informal borrowers. Pricing becomes exponentially when terms aren't transparent or when aggressive recovery practices are used. Regulatory responses. To mitigate this risk, regulatory like RBI introduced interest rate caps, mandatory credit bureau checks, and strict transparency requirements. The responses to excessive commercialization. Following widespread borrowing distress, tight norms were introduced. This forced commercial microfinance to redesign their products and slow down their expansion to ensure borrowers' protection. The case study and the questions. Regulatory regulations help restrict excessive pricing and limit multiple borrowing. The RBI acts as a vital counterweight to unchecked profit motive, ensuring financial stability in the sector. Small finance bank. The transition to a small finance bank is a pivotal movement. It allows institutions to accept deposits and offer full banking services, but it also brings much strict compliance and higher costs. When a large microfinance converts to a small finance bank, it gains the ability to mobilize deposits. However, increased regulatory burdens can reduce the flexibility they once had to serve very small borrowers. Becoming a small finance bank is the highest stage of commercialization because it moves the institute into mainstream banking. The challenges is that while commercialization strength improves, the original grassroots focus may weak. Is commercialization inevitable? Given the demand far exceeds donors' funds, capitalization is often seen as a necessary evolution for sustainability. The key is balancing profit with social mission. The advantage of commercialization the includes better financial stability and expected borrowing base, improved governance, and the use of technology to boost efficiency. The inevitable factors. Comparing to microfinance, one remains donor funded and small, while the other commercialization reached millions. While the first kept its social focus, its impacts was limited by its small scale. The demand for credit far exceeds donor resources. Sustainability requires stable capital. Scale is essential for meaningful impact. Enabled social goal in strength, monitoring borrower outcome, aligning incentives with the responsible lending. Risks of commercialization. Commercialization of microfinance carries significant risks, including mission drift, overlending, interest rate controversies, and highest pressure on staff. Potential compromising social objective and borrower welfare. In conclusion, while commercialization enables growth and scale, it carries risks like mission drift and overlending. Regulation is essential to ensure the profit away aligns with the unlimited goal financial inclusion. Thank you for hearing me. Thank you.